Welcome to the Nichols Tax Update Podcast, Issue 2113, March 29th, 2021. This program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and expert comments on hot topics. You are receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. I always acknowledge the value in preparation of this program of my subscription to Tax Notes Today, published by tax analysts, the preeminent source of information for tax professionals for over 40 years. Let's get to it. It was a quiet week for the kind of things that we normally run into. I did identify three items that interested me. I thought they might interest you. And then it occurred to me that we need to go to work on these parts of the American Rescue Plan that will affect, first of all, our 2020 income tax returns, and then our 2021 planning. And over the next week, you will receive notification as we put up the pieces of our analysis for the child tax credit, for example, the changes to the earned income credit, and finally, I hope we get through it this week, a complete analysis of the big piece, the revenue ruling 2021-21. I forget the exact reference, but I will write it down and I will have it ready when we go to work on it. So, speaking of going to work on it, let's go to work. The IRS has shocked some of us by adding incomplete gift trusts to the no rule list, meaning that we can't get a ruling, and we got rulings just as a protective measure here when we were creating an incomplete gift trust intended to avoid being classified as a grantor trust, intended to create a separate entity primarily before now to deal with state taxes. But not so now. The advantage of those trusts is that the IRS has ruled for years that their distribution committees, usually made up of their beneficiaries, were adverse parties, which allowed the trust to avoid grantor trust status. Recent changes to Section 199 Cap A, the limitation on state taxes as itemized deductions, has made the creation of trusts much more attractive as income tax reduction devices, in addition to their historic use as protecting against wealth transfer taxes. Absent the ability to get a determination letter, one commentator wrote that reputable practitioners, meaning people like you and me that want to avoid unnecessary risk, may be reluctant to move forward with incomplete gift trusts, or certainly we will not be able to give our clients any assurance that such trusts will now escape scathing attention, perhaps, by the IRS, with the intention that they will be classified as grantor trusts and we lose all the benefit. That's what we need to know about Revenue Procedure 2021-3. Now, with regard to this private letter ruling, every week we sort through a score of private letter rulings on all sorts of things. This one is fairly common, but it caught my attention because we haven't talked about it in a while. Here, we have a plan which is seeking a ruling as to the treatment of its payments to beneficiaries. This is a city or county retirement plan that pays death benefits in lump sum, or it may pay death benefits as an annuity. It also pays disability benefits, and it pays regular pensions. So the plan is asking when and how do we have to report taxable distributions? The IRS reassures the plan in this private letter ruling that payments to a surviving beneficiary of a deceased member of the city's governmental plan that are simply a continuation of job-related disability payments and service-connected death benefits will be treated as non-taxable under Code Section 104, while other benefits determined based on the member's age or length of service are taxable as pensions under Section 72. That is not hard, but it is an important distinction, and the plan wants that distinction so that they do not make a mistake in reporting to plan beneficiaries. I love it when I can find the right artwork. Here's the artwork for frequently asked questions. 5 questions and answers to help tenants and landlords comply with the law governing emergency rental assistance. The tenant will not include assistance payments in the tenant's income, whether they are used for rent or utilities. Further, the tenant does not include in the tenant's income payments which are sent directly to a landlord. Then the landlord includes the payments in income because the assistance is to help the renter, not the property owner. So the government's payment of a tenant's rent is taxable income to the landlord, but not taxable income to the tenant. And finally, if the utility company receives a payment from the governmental agency directly to pay the tenant's light bill, the utility company, like the landlord, must include the payment in income. That's 5 frequently asked questions issued last week. Now, that's it. But no, that's not it. Hold on a second. Let's talk about some provisions of the American Rescue Plan Act of 2021 that we really should know in order to properly prepare 2020 income tax returns. So here we go. Federal unemployment payments of $300 a week were extended by this plan through September 6, 2021. The full cost of COBRA premiums is subsidized through September 2021, and $10,200 in unemployment benefits received in 2020 is exempt from income tax for households making less than $150,000. But you may have questions about the details, so stay with me. Here are the details. If the adjusted gross income of the taxpayer for a taxable year beginning in 2020 is less than $150,000, and that's the bogey, that's the magic number, the taxpayer's gross income will not include up to $10,200 of unemployment benefit. That same $150,000 limit applies to returns whether they're filed jointly by head of household or single status. In the case of a joint return, the $10,200 exclusion applies separately to each spouse. Each spouse gets the $10,200 exclusion. So if you have a joint return and each spouse received $10,000 of unemployment benefits and the adjusted gross income without those benefits is $140,000, the spouses together can exclude $20,400 of unemployment benefits. There's no income phase out here. It's a cliff. And the edge is $150,000. Section 85A provides that if a taxpayer's AGI is $150,000 or more, the exclusion does not apply. All of the unemployment income is taxable. If the taxpayer's AGI is $149,999 or less, the exclusion does apply. And for purposes of this exclusion, the question I know you were about to ask, AGI is determined before you count any unemployment compensation. Then there are some business tax rules in the Act. The Restaurant Revitalization Grant Program, along with economic injury disaster loans, are excluded from the grantees, the recipient's gross income. I've got a brief explanation of that on the following slides. Entities that are eligible for the restaurant revitalization grants include restaurants and bars, food stands, food trucks, food carts, caterers, saloons, inns, taverns, lounges, brew pubs, tasting rooms, tap rooms, and any licensed facility or premise of a beverage alcohol producer where the public may taste, sample, or purchase products, or any other similar place of business in which the public or patrons assemble for the primary purpose of being served food or drink. Got that? That's anybody and everybody that serves food. The Act provides assistance to the restaurant industry in the form of grants, very similar to the PPP grants. If you were hurt by the COVID-19 pandemic and you can prove it, you may have access to a piece of that $25 billion restaurant revitalization fund. $5 billion of that is targeted for grants to small restaurants controlled by women, veterans, and socially and economically disadvantaged individuals. Comes under the heading of Black Lives Matter, and there will be special attention given to minorities, not necessarily blacks, but blacks, Hispanics, and other identifiable minorities. Restaurants impacted by the economic fallout of COVID-19 may be eligible for a grant of up to $10 million to cover eligible expenses, and you got to prove the eligible expenses going all the way back to February 15th of 2020, which is why we included this information in this program, talking about what you need to do to complete the work for 2020. Amounts received from the SBA as restaurant revitalization grants, that's where they're going to come from, will not be included in gross income of the person that receives the amounts. No deduction is denied, no tax attribute is reduced, and no basis increase is denied. The amounts are treated as tax-exempt income. So in the case of an S corporation, for example, that receives such a grant, the shareholder's basis is increased, but not the AAA. A partnership will increase the partner's capital account and the partner's basis. Any amount excluded from income, well, the partner's capital account and the partner's basis, the amount received is not included in the partner's gross income, but the partner gets credit for it in the partner's capital account. So any amount that is excluded from income is going to be treated as tax-exempt income for the purposes of Section 705 in the case of a partnership and Section 1366 in the case of an S corporation. There are rules for calculating the allowable amount of a grant. Entities are limited as to size, gross receipts, number of locations, etc. Self-certification will be subject to examination by SBA auditors. Grant funds can be used for the same expenses as the PPP loans that we started receiving almost 2 years ago, well, a year and a half ago now. Any entity that got a PPP, well, no, I guess it's just a year, how time flies. Any entity that got a PPP loan is not eligible for a restaurant revitalization grant. Preference will be given, as I mentioned earlier, to restaurants owned and operated by women, veterans, or socially and economically disadvantaged individuals. If you don't spend the money, you made your case, you got a grant, and you don't spend it all, you have to give it back. I couldn't find any place for returning money except by obviously a burglar or a convict. You're not necessarily a convict or a burglar if you got more grant money than you spent, but you're an eligible entity, you got a restaurant revitalization grant, you don't use all the grant funds for permitted purposes within the time allowed by the statute, you got to give the money back to the Treasury. And that, dear friends, is a wrap for this week. Thank you, and remember, until next time, please stay safe. We're all going to get through this together.